Liquidity risk is defined as a financial institution not having sufficient cash or liquid assets to meet borrower and depositor demand, or an entity having difficulty in raising funds to meet commitments associated with financial instruments. And according to a new report by the International Monetary Fund, more needs to be done to mitigate liquidity risks when markets are interrupted after cataclysmic events like the Japan earthquake.
More needs to be done to mitigate systemic liquidity risks that can arise as a result of funding markets shutting down and institutions not being able to fund themselves. The Basel Committee's liquidity standards should help banks improve liquidity risk management at an individual level. The rules, however, by their very nature, do not address liquidity risk concerns that can arise out of the interconnectedness of financial institutions across markets. Regulators need to develop an instrument that can capture an institution's contribution to systemic liquidity risk. This would allow for more effective private and public burden sharing of systemic liquidity risk. We do not take a stand on whether it should be an insurance premium, a surcharge, or a fee. Further analytical work would be necessary to determine which method would be most effective. What we do in the report is we propose 3 separate methods that measure systemic liquidity risk and an institution's contribution to this risk. It is essential to improve data disclosure practices to allow for better assessment of liquidity risk. For instance, providing more information on banks' liability structure, including contingent liabilities, would allow investors to better assess the robustness of institutions' liquidity risk management practices. In addition, more information on the use of funding markets by institutions as well as their liquidity buffers would help supervisors better assess the probability of liquidity strains building up within an institution and within the financial system. Hence, more information on liquidity risk would also likely reduce the use of central bank money during times of crisis.